elect to itemize your deduction rather than use the standard deduction. We just talked about standard deduction versus itemized deductions. I'm sorry we have to go very fast of what some of these differences are, but this one is creeping up on a lot of our clients and has been for a number of years. There is a little second set of taxes that are done out there called alternative minimum taxes. I cannot believe somebody wrote this stuff down. So you've got all this giant tax code where you're figuring out your income taxes, and parallel to it, going right along with it, is a whole nother separate tax calculation that is being calculated simultaneously called alternative minimum taxes. And it's basically saying, yes, we're giving you all these tax deductions, but if you got too many of them, we're going to add them all back for alternative minimum tax purposes and tax you at the higher of your regular tax or your alternative minimum tax. It's awful, okay? Because it's trapping many, many people. You did a lot of good tax planning. You have all these great deductions and you can't use them. One of them is related to your standard deduction. I mean, give me a break. They've given you the standard deduction, but guess what? For alternative minimum taxes, they make you add back your entire standard deduction in calculating that parallel tax. So this is one we have to think about a lot. We say to ourselves, well, even though our itemized deductions are less than our standard deduction, if you are in alternative minimum tax, and you would know that if you use a computer program, it's going to say you're subject to AMT, you can rerun your tax return, not using the standard deduction, but doing all your itemized deductions, even if they're less than your standard deduction, that may lower your alternative minimum tax. So it's like backwards thinking in a way, and just be aware of it because it has helped a number of our clients. Here's one that is I was just telling Wes Moss about it, our new radio guy. He did not know this. One of his clients called and asked me, there's something out there called investment interest expense. Okay, investment interest expense is interest expense related to purchasing investments, like you have a margin account and you create, which I do not ever believe in using borrowed money to buy an investment, but some people do. And if you have that investment interest expense, you can only offset other investment income. So what I'm saying here is that first of all, investment income is things like interest and dividends. But it is not things like your long-term capital gains and the qualified dividends that are subject to the lower 15% tax. A lot of people don't realize this. It's a little hidden gem. You can elect in any particular year, which normally you would never do, but you can elect to treat your long-term capital gains and your qualified dividends as investment income, thereby subjecting it to a much higher tax rate, your ordinary tax rate, which is crazy to do. Unless you have a whole basket of investment interest expense that's locked up because you don't have enough investment interest expense to offset against. Now all of a sudden you do, and you can use all that investment interest expense and wipe out that capital gain and qualified dividend completely. So reducing your taxes to zero just helped one of Wes's clients. He was so excited about it, and again, you never know which one of these may apply to whoever. That's why I covered them all. Here's one related to real estate, and I do have a separate, I don't know which one I like better. This tax one you see is very exciting. It's tough to beat the excitement of this, but the real estate one is also really exciting. But here's one that really ties into real estate. A lot of people own just plain old vacant land, and there are a very crazy set of tax rules out there that say if you own real estate and you create a tax loss from that real estate, that's considered, by definition, a passive loss, meaning that you can't use those losses from your real estate to offset your other income, like your W-2 income. It can only be used to offset other real estate income, and that's it. So it gets locked up. That's from any real estate. But land that isn't being rented, if you have interest and taxes from land that you haven't developed yet, don't let that sit in the passive loss category. You can take that out and itemize that as a itemized deduction. That's like a special little carve out just for land. Again, may apply to some of you. It has helped a number of our clients. Here's a cool one. We all are into these credit card rebates. My goodness, there's so many different credit card rebate offers now. I'm a big believer on only using credit card rebates that offer a cashback rebate. All the other ones are the biggest bogus scam ever in existence. You know, everybody wants to use their Delta Airlines Sky Mile 1 total ripoff. Makes no sense. I'll touch on why. But the best ones are any ones that offer a cashback rebate. And there are some great ones. And by the way, we custodian all of our clients' assets through Charles Schwab. And I just learned 2 days ago that through Charles Schwab, if you open a free banking account through Charles Schwab, you can go to schwab.com, free checking, free checks, no minimum balance, they pay you interest. Every time you use their ATM card anywhere, they rebate you for the ATM fee. It's a no-brainer. I love that. They also have a 2% cashback credit card that they will deposit that money right back into your checking account. That's beyond great. Is that not true?
It's pretty much true. It's schwabbank.com.
Oh, schwabbank.com.
Yeah, and you have to have a brokerage account at Schwab, and they rebate it back to your brokerage account.
Got it. So you can open a small brokerage account at Charles Schwab for free, $1,000, whatever little bit amount you want to put in there, then open up the free checking account, then get this cashback rebate card. I get no benefit from this. I'm just telling you I love it. So what I'm saying here is that when you get that cash rebate, you can donate that to a charity, and it's another one of these free deductions, because you get to itemize that as a deduction. So you got 2% cash back in your, let's say, $1,000. You can donate that to a charity, but you never had to take that $1,000 into income, and you still got the tax deduction. It's pretty nice. If you're wanting to be charitable minded, do it that way rather than through your already taxed dollars. And let me go back to that one other point. Here's the thing. Let's say you have a credit card with airline miles, okay? And you have to spend. Let's say you spend on that credit card a typical airline ticket. You have to redeem like 25,000 points. Well, you never get it anyways. It's very hard to redeem it for the 25. They usually then say, oh, that we sold out of the one seat we had reserved for that, so it's 50,000 miles. Now let's take that same $50,000 that you had to spend on your credit card to get the $50,000 miles. What is better? Redeem it for an airline ticket, which probably the cost of that ticket wasn't much more than $250 anyways, or now take that same $50,000, multiply it by 2%, that's $1,000 cash that you can use for anything you want, not limited to an airline. So what's better, a $250 airline ticket or $1,000 cash? It always pays to get a cash back rebate credit card, even if it was a 1% one. There's plenty of those out there. That's $500 cash versus the $250 airline ticket. Little side tip. I also talk about in here about using per diem rates rather than the actual mileage for your car. It's you get a pretty nice deduction when you're writing off auto miles by using the per diem rate. That's just a given amount of money per mile that you use your car for. It's also much easier to substantiate if you're in an IRS audit. Trust me, I've been, dealing with the IRS auditors for 20-something years. I know which things get by them easier than not, and they tend to like the stuff that they say is an automatic, which, is one of those.